Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well.
Morning, team. Hope you're all doing super well. Coming from down here in freezing cold Melbourne. Hope wherever you are in the world, wherever you are in Australia, you're all doing well. Welcome to Wealth Coffee Chats. My name's Andy Fenton here for another session on Thursday. But today we're going to have a little bit of a riff on a few frequently asked questions that relate to, what's the changes that relate to super? What should I be aware of? What's the changes to tax? What should I be aware of? Just going to share with you some quick little insights as to, how you can prepare yourself for this year. If you've got any questions, whack them in the chat, and I'll do my best to get to those as we go through. But before we get into it, give us a shout out. Let us know that you're here. Let me know that I'm not just talking to myself. As handsome as I am this morning, just joking. Don't know where that came from. Clearly haven't had enough coffee. Jeff's on board. Gold Coast, mate, heading to Singapore to warmer ways, mate. Good to have you on as always. Kevin, good evening from Florida. Kevin, you're dialing in from Florida a bit these days. There's some interesting stuff going on in your neck of the woods at the moment. Luke, good to see you, mate. Good morning. James, good to see you. Share the rule. Woohoo. Yes, indeed, Jeff. You're not talking to yourself. Thanks, Jenna. Appreciate it. Makes me feel a little bit more sane. And welcome, Rebecca from Sydney. Well, hopefully, wherever you are, you're staying warm. You're warmer than what I am. For those of you who don't know me, Andy Fenton, co-host of Wealth, Wine and Wisdom, to be returning sometime soon. We do promise, with a slightly different format. Filling in for Mr. Witten, who is currently on sabbatical. Well, we'll call it a sabbatical, climbing somewhere around the world. But good to be with you all this morning. As I said, Andy Fenton, Director of Fenton Financial. We've got an advisory business down here. So, of course, I'm going to start off with a disclaimer. You must go and chat with your advisor and financial professionals before implementing anything that I have to say today. I could be loose. I could be wrong. It happens. But I'll do my best to be right. Geez, I haven't even tucked my collar in this morning. But good to be hanging out with all of you this morning. Look, just thought I'd answer some questions. I've gone through this a little bit in the PRE world, gone through a little bit in my world. But people keep asking, where are tax rates at? What's the change? What are some little tips and tricks in and around it? What's happening with super for salaried investors? Also for business owners, how's that going to impact? What are the opportunities that creates? And then, what are potentially some things that we might have lost? There's more and more people starting to become familiar with these deductions that are available through carry forwards and how to use those as property investors. And this is where you should really be chatting with your your 6-star team in order to be able to navigate the highways. Just before I get cracking, who's been watching the news recently? Just if you've been watching the news, put a Y in the chat and just let me know whether there's anything decent going on. I've been on a news and digital detox for a few days, or actually over a week now. I haven't watched a single bit of news. Turned on the channel this morning, started looking at what's been going on in the world. The French election, oh my God. There's some Asian property investor influences down on the Gold Coast. There's all sorts of stuff which I can't wait to sink my teeth into. Perhaps on Thursday, we'll have a little bit of a riff around what's in the news and what you should be listening to and what you should be just completely ignoring. Red hot tip, about 90% of it is in the ignoring file. But maybe to put some context around some of it. There is fear, headlines left, right, and center. Words like threatening, words like decimated market being invested in, 500 billion on the Gold Coast. One that I tend to agree with, which is the US election. Wow. What an interesting state of affairs that we're in. But with every interesting state of affairs comes some incredible opportunity. So let's have a little bit of a riff around what's in the news on Thursday. If you're happy to join me, that's where I'll get to wax lyrical a little bit. But today, going to focus on the facts and run through, what's the change of the landscape and what can you be doing about it? What are some little tips or some of the ways that we look at the world in order to be able to pay less tax, or at least minimize our tax where legally possible, and some opportunities, especially for property investors, that may be there if your balance for super is under 500,000. You're looking at jacking that up, maybe looking at other investments inside super. Some little strategies that you can be aware of that you can take to your advisor and to your team to implement professionally with them. As I said before, you must chat with your advisors before implementing anything that I have to say. So I've done my best to make sure these numbers are correct. They're all sourced from the ATO and from relevant websites. So if in doubt, go to the ATO, check it out. But team, what's happening? What's happened in tax rates? Well, what I'll share with you is the benefit. For those of you who have listened to some of the awesome updates that we run at, or that Jason and the team run at PRE, the economic updates and things of that nature, we've gone through a little bit of this, but thought you might be interested. I mean, one of the things that I thought was incredibly smart by the politicians, I did say smart, and yes, by the politicians, when it's self-serving, quite often they can be quite clever. So the tax cuts that came in more recently, ultimately, everybody won. And so I don't know if many of you know 7 Habits of Highly Effective People. Stephen Covey, I think, was the author of the book. Talks about clean and green. He talks about win-lose and how to create a win-win. I think that this is where they created a win-win, but of course it had a bit of a win-lose for some people in there as well. But what's the brass tacks of the tax cuts? Ultimately, for this year, and this is why I thought that it was very smart, they did give a haircut to the top marginal tax rate. So that's where the loss actually happened. But mostly it was a win-win. It was hard for anybody to say no to the proposal because pretty much everybody won in some way, shape or form along the tax cuts based on last year's tax rates anyway, not based on the proposed ones, which I'll jump into in a moment. So what does this mean? So team, I just want you to think in the lines of, yes, inflation's gone up, but if you can still live on the same, morning, Tim, if you can still live on the same, you're out here in Australia. I do apologize, Kevin, this is going to be a little bit more Australian focused today, but I promise on Thursday, we'll have some cool stuff to talk about. Hold me to it. I'll make sure that I do, Kevin, because I'm very interested in your neck of the woods at the moment, over there in Queensland, over there in America. So what happened over here? Well, if you're in the, if you're able to live on what you did last year, then what I'm about to take you through is the potential for more savings, more investment, more funds offsetting, right? That's if you can. I understand that inflation is having its impact, but if you can live on what you did last year as far as money that you're spending, then everything that comes in here is going to be a saving to you, or it could be an investment to you, or an offset for you, should you choose to use it that way. So if you're earning between 18,200 and 4,500, 18,200 and 45,000, then your tax change is going to be about $804 difference. Right, so that's $804 that you can save from investing, offset, whatever that may be. If you're in the income tax bracket between 45,000 and 135,000, now this is taxable income. So if you're a property investor, take off your depreciation, take off all of your deductibles, take off your deductible super contributions. What is your taxable income, right? Which you should all know. If you don't, chat with your coach, chat with your advisor, figure out what that number is. You should always know that. It helps you pay less. So know your numbers, pay less tax. That's the general rule. So if you're earning between 45 and 135,000, well, you've got $3,729. That's going to go straight to the bottom line. Okay. And then if we're between 135,000 and 190, then you've got about 4,529, and same for 190,000 and over, right? Not huge, but that's something a little bit more in your pocket. So it's going to make, well, yes, Tim, as you said, for those of you who are earning over 200, it's going to start to make some sense to start to look at structures. And that's something that we're definitely looking at riffing on and bringing to all of you some good strategies in and around that so that you can minimize your tax. Because did you know, and let's just ask this, if you earn over $250,000 worth of taxable income plus your super, right? What is the gift that you get given by the Australian government if you earn over $250,000? Does anybody know what it is? You get a gift. You get a gift. It's not a gift that feels good. It's Div 293. And that's an extra 15% tax on super contributions. Yep, that's it. Brian's onto it. Div 293. Most people who are onto this have probably been touched up by it at one point in time. You get this funny little, yes, Rebecca, additional tax 293. You get this bill that just comes in the mail. It says you owe an additional amount of money to the government. Doesn't often get taken out beforehand. Very few people actually let you know that it's happening. If you don't plan for it, you just get this random funny bill that comes. So you should be aware of this as well. Like if you're looking at, yes, being touched. Brad's been touched by this 293, that is. If you're going to sell an investment property, I know Witten says buy well, never sell, but if you're looking at needing to, or looking at transitioning your wealth at some point in time, then you do need to be cautious of this one. You need to be very, very cautious of this one because you may end up paying an extra 15% on the money that you put into super. If you want to know more about it, check out the ATO website or let us know. We'll do a little bit of a session for you, take you through just what the rules are. We can't give you advice in this forum, but we can at least take you through what the rules are. And then you can chat with your team of professionals in order to figure out, how to manage that. So yes, an extra 15, it's double the amount of tax, double if you go over the 250 mark. So 250 is a magic number. 200 is actually the other magic number because 200 is the new 180. Now, what do I mean by that? Well, let's have a little bit of a look. So basically, depending on where you are in the tax scale, you've got an extra $4,000, $4,500 worth of tax that you will not be paying. But if you were earning, say, 190 or thereabouts, and we did the inflation adjustment and we adjusted. So how much do you reckon you would be ahead or behind if we adjusted these numbers for inflation? Now, let me just tell you exactly what I mean by that, right? So $4,500, right? So let's just pretend for a moment that you're earning $190,000 taxable, right? $190,000 taxable. And if we adjusted that for inflation, right, which means the average cost of you spending your money, out there has gone up, right? Milk has gone up. Petrol has gone up. A loaf of bread's gone up. Everything's gone up. Almost everything's gone up. Some things have gone down. Not very many things. But let's just say that we adjust that for inflation. So the government's given you $4,500 back right? $4,500 back by way of a tax cut. But if we adjusted that for inflation, the first question is, would you be ahead or behind? Right? Ahead or behind? Whack that in the chat. Would you be ahead or behind? And then give me a number, an estimate of how much you think you'd be ahead or behind. We'll just take a guesstimate at it. I wasn't planning on doing this. That's why I'm actually calculating it now. What do you reckon the number would be, team? What do you reckon it is? It's really interesting. I think more people should be aware of this conversation. It's been a long time since we've had, periods of time where inflation has run a little bit over, a few years. Got to get the tax man out. Yes, Jeff. Always love your comments, mate. Jeff, 1%. Jeff reckons maybe 1%. That's, I'm assuming, coming from you, Jeff. You're going to say that's 1% negative, only because you're switched on. All right, not too many players in here. Well, I'll give you a hint. You're behind, right? So here's how you'd sort of work it out, right? If you've got 190,000 that the government or your taxable income, yep, and you factor that in for inflation, yep, you're not too far off there, Brad. Depending on whether you do net or gross of tax, right? If you do including tax, you're behind $8,800. Right? If you do it net of tax, it'll be a little bit less. I'll tell you what it is. Stay tuned, callers. Spontaneous calculation coming up, 190. That'd give us a total of, so if you're earning 190, you're going to be paying $55,000 worth of tax, and you'll end up netting times 7%. Minus 4.5. Yep, there you go. So you will be somewhere between, depending on a few variables, based on inflation, you'll be somewhere between $3,900 and about $8,000, depending on which calculation, net or gross. That's how far you'd be behind. Very important to understand that. For those of you who've listened to me wax lyrical about this, I get a bit heated at times, but ultimately, 14 years ago is when they brought in the top marginal tax rate of $180,000. If they'd linked that to inflation, it'd be circa somewhere in the vicinity of about 270 today. So that's what we call bracket creep. Bracket creep is real. We might run a session specifically on bracket creep because it's a big topic and kind of need to explain it. But ultimately, very condensedly, what bracket creep is that if you've got net $100,000, right? So after you pay tax, you've got $100,000 that you've earned over the course of the year. And it's exactly the same for the next year. Let's just assume there was no change in tax rates whatsoever, but inflation ran at 10%. Let's just make it easy. If inflation ran at 10%, well, then next year, that $100,000 would be buying you only $90,000 worth of goods, but you're still paying the same amount of tax. So the government is getting more of your discretionary or of your spending dollar. You're receiving less because the costs have gone up. So you need to make more in order to buy the same, which means you'll pay more tax. That's what bracket creep is all about. So anyway, let's not wax too lyrical on that. Don't have too much time to run through it. So team, we know what the lay of the land is with the new tax rates. And ultimately, I'll just run through them here for you. We'll start sort of at the 45,000. So, because not much has changed really until we get up to 45,000. So 45,000 to 135,000, you got 30% tax. It's 37% tax from 135 to 190, and then over 190 is your 45 or plus Medicare levy. It is 47 cents in the dollar, right? So it's the stage 3 tax cuts that were proposed, and that's a bit hard to read there, was 200,000, right? So they were starting to lift that top marginal higher in order to compensate for the inflationary effect. But that was clawed back a bit by $10,000. Should be 270, around about there if we linked it to inflation. But anyway, that's what's happened. So now we say that 200 is the new 180 because ultimately you'll pay roughly the same amount of tax if you earn 200,000 a year now as you would if you earned 180, right? But we've got to be careful of the good old Div 293. So just a quick update. What's happened, what's changed in the laws in and around superannuation. So for those of you who are salaried investors, you will now be getting 11.5%. So that's up 0.5%, 11.5% SGC super. If you're an employer, make sure that you adjust your numbers because you have to pay that. So it's definitely a gain for team members and salaried employees, salaried investors, bit of a loss for business owners, right? So that's another tax on business owners, but it's a great benefit as well for team members. The concessional contributions cap has gone up to $30,000 this year, which means that you can get $30,000 into superannuation pre-tax or pre-personal tax and claim a deduction for that. So that could be your SGC, so that's your superannuation guarantee, which is via your employment, so it's linked to your wage. It could be personal deductible contributions or it could be salary sacrifice. Right. So you can have these directly from your employer. You can contribute them additionally from your employer, or you can contribute your own money and claim a tax deduction for it. So that's up to $30,000 now. It won't affect the previous year's carry forward, which I'll chat about in a tick. So how do you use that and what's happened in carry forward? What is carry forward? But that's gone up to $30,000 per annum. So you can get more into super, which is great news. That needed to go up and that will continue to be indexed. Well, hopefully it will. Hopefully they don't change the rules. Then post-tax money, you've gone from previous cap of 110,000, which means you could take 110,000 per year and put it from your bank account into your super. Now, 110 has gone up to 120,000 per year. You cannot claim a deduction for it, but it has increased. So look these up as concessional, non-concessional contributions. You'll find everything that you need to know on the ATO website. But just to know that these amounts have gone up. So if you need to get more into super, you can get more in on a deductible basis, the 30,000, and without claiming a deduction, you've got up to 120 now. So a little bit of extra. If you're going to use, if you're under the transfer balance cap or the total super balance of 1.9, then you've got the potential of being able to utilize 3 years worth of bring forward. You can use 3 years of your contributions in a single year. Check with your advisor. There are rules that apply and you need to tick off on those before making those contributions because there's pretty severe consequences if you put in too much. So you could get potentially up to 360 in without claiming a deduction in a single year if you satisfy the right criteria. Chat with your advisor. So the thing that I'll finish on now, and it's very prudent for property investors, more and more people are starting to cotton on to these types of strategies. We've been talking about it for, well, pretty much ever since it was brought in. So many of you would already know about this. But in the Australian super system, they brought this thing in called the carry forward, which basically meant that unused contributions from previous years could be utilized in this year with some certain rules that apply, right? Again, you need to chat with your advisory team, but a couple of the core rules, which is your total super balance, if that's under 500,000, right? That has to be under 500,000. If it's over, you're not eligible. You need to be eligible to be able to contribute to superannuation, right? And then there's a few other specific rules that apply and you need to be aware of them. So you do need your advisory team to do this. Chat with your 6-star team and your financial advisor and accountant. But I'll just take you through what's changed, right? So in 2018-19, you're able to contribute a maximum of $25,000 into super and claim a deduction for it. In 2019-20, it stayed the same. 2021, it stayed the same. 21-22, it was indexed up to 27,500. Then 22-23, it stayed at 27,500. And the year just gone, 27,500. So what's happened? What happened this year? That's the question. I'll answer it in a moment. So how does this work? Well, if in 2018 you only did a $10,000 contribution, then in theory you would have $15,000 that was unused. Again, if you did that, you'd have another $15,000 that was unused. So your total amount that you could carry forward would then be $30,000. which means that the next year you could potentially put in $55,000 as a total contribution. So let's just keep it easy. We put 10,000 in each year, and you've been able to carry forward 15,000. Then when the index changed, it was 17,500, right? Which means the amount of carry forward that you have continues to increase to $80,000, right? Which means that for last year, if you were in that situation, you would potentially be able to put 97,500 into super in one foul swoop and claim a tax deduction for it. So if you had a big gain, that would almost wipe out $180,000 worth of capital gain. If you have a partner, times it by 2, that's $360,000 potentially worth of capital gain, right? You've obviously got your income and other things that you've got to factor into it. As I said, chat with your advisory team. So that's where we were at last year. But one fundamental thing has changed this year. So in 2024, 25, the cap has gone up to 30,000, as we just said. Right. So let's just say that again, we put in 10,000 this year. Well, that was how much your SGC was. Right. So how much would be unused? It would be 20,000. Right. But what happened this year is this is the first year where we've lost a year, right? Because you're only allowed to do it for 5 years plus the year that you're in. So effectively what's happened is now you're not eligible, right, to receive the contributions from 18, 19. We can now only go back as far as 1920. Right, so that means that when we're looking back, if we had unused, if we had this $15,000, that's gone forever. You can't access that anymore. Oh, whoops, sorry, not that one. It was this one. You can't access that anymore. So we just need to do a recalculation of where we would sit, right? And as we're moving across here, we've got to take the 15,000 off because that's no longer available and put the extra 5,000 on. So we'd be somewhere in the vicinity of 102,500. Right. So if you need to know your carry forward contributions, the simple thing is it's very, very, the good thing is simple, easy to find out. You can log on to your MyGov and look into the ATO portal through your MyGov site. You can go to super, you can look at carry forward contributions, and it should be up to date. If you've got a self-managed super fund, it becomes a little bit harder. Because you'll need to chat with your accountancy and your advisory team in order to figure out that number because the ATO may not be updated. But team, the tax brackets have changed. In summary, the tax brackets have changed. Inflation has gone up. You're proportionately paying the government more based on how much you're spending. So it becomes more and more important to make sure that your tax management is super, super slick and you're preparing for the future. Your super balance hopefully will go up because you're contributing an extra 0.5% if you're an investor that's employed. If you're a business owner, you should be paying yourself super as well. But ultimately, your team, there's a little bit of a tax as a business owner as well. Make sure that you're paying that. And then be aware that we can contribute a little bit more into super. So if we want to take advantage of those tax deductions, chat with your advisory team. It's there, available. We lost the last year now of carry forward. So if you haven't used those, they're gone. Unless they change the rules, gone forever. But you do get this year, which has gone up to $30,000, and you can still access those carry forwards if you're eligible. So the key ones to look at: superannuation balance per member under 500,000, still eligible to contribute to super. Those two things you tick off, then you should chat with your advisor and look at ways that you can potentially minimize your tax using super contribution if that's right for you right now. That's why you need to chat with your 6-star team and make sure that you're on the right track. Your accountant, your advisor, your property coach, all of those people should be part of your team. You consult in order to be able to map out a plan for you managing things forward. But it's always good to brush up on the knowledge around these things so that you can ask the right questions. Team, that's it for me for this morning. As I said, back into the news. So we'll get out of the fact side of the equation because they don't report any of that stuff. And we'll have a look at what's actually going on in the world of the media, and maybe debunk some of the misnomers that are out there. Maybe provide some logic amongst the noise, and hopefully have a little bit of fun while doing it. Team, it's been good hanging out with you. From me to you, enjoy the morning. Join us again 8-10 p.m. tomorrow for another Wealth Coffee Chat. I'll be on Thursday. Look forward to seeing all of you there. Thanks for playing full out. Tim, Jeff, Brad, Brian, Sonia, and who was it again? I promise that we'll get on to the US stuff. Kevin, we'll see you all tomorrow, and I'll see you all on Thursday. Have a great day, team. Enjoy your coffee. Be well. Plan well.
Episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6 Star team here at positivementor.com.au.